Hi, I'm Debbie Moraes, your host and moderator of Legal Matters, the program that's been designed to address critical issues, sometimes contentious issues that are facing consumers and businesses today. It's legal information, practical solutions, and straight talk about a wide variety of topics that will affect your home and work life. We want to begin, as we usually do, by thanking our legal counsel and sponsors from the Bazar, Grasso law firm in East Providence, attorneys Jacqueline Grasso and David Bazar.
Hey, Deb.
So, the downturn in the housing market beginning back in 2007 or so impacted millions of Americans. Foreclosure rates skyrocketed. There are still problems with it, but there are two government programs that homeowners have been experiencing or are usually eligible for, HAMP and HARP. We're going to explore those a little bit today. The Home Affordable Modification and Home Affordability Refinance Program. But many are confused about which program they might qualify for, what the differences are. So today we're going to be talking about and clearing up that information, steps that you might need to take to see if you qualify. We're going to review some frequently asked questions and also supply some of the resources that you need. You've probably heard the Obama "one more year" story. It's a fairly recent rallying cry because we're going to be fixing those damaged mortgages. So let's start with, I guess, Jackie and David. Give us a little bit of the background. There's HARP and HAMP and HARP 2. Give us a little background.
HAMP started as a government program for those people who were severely delinquent in their mortgages. The acronym stands for Home Affordable Modification Program. So people were seriously delinquent in the mortgages. They needed a way to try and modify the loan. In the old days, what would happen is you would take the delinquency and do what's called a mortgage workout agreement. So you'd amortize it over a couple years with your lender. But the HAMP program allowed the lenders to actually modify the loans. Now, the qualification is it had to be an FHA-backed loan. So Fannie Mae, Freddie Mac, they had to be qualified. If they were not those type of loans, then the modification was purely voluntary with your lender. The HARP program is the Home Affordable Refinance Program. The major difference between the two is you're refinancing. A modification is not a refinance. It's just changing the terms of your loan. Refinance, it's the same loan, but or it could be a new loan, but you're actually paying it off, and in some cases you may be able to reduce your principal balance. With a HAMP program, 99% of the people are delinquent. With a HARP program, you can't be delinquent. You have to have at least 12 months of regular monthly payments. For both, it has to be your primary residence. So there are different qualifications.
And how do you know if you qualify, considering you might have been doing pretty well keeping up with that current mortgage, but then things happened? Things happen with the mortgage market downturn, and suddenly you owe more than what your house is worth, or you lose a job, or you don't lose a job, you have a different financing structure. What happens then? How do you know? What do you do?
So the refinance program, you cannot be behind on your mortgage, but it's designed for people whose homes are worth less than the loan, so that you have little or no equity. You're underwater, as they say. So to qualify, the first thing that you have to have is 12 months, as Jackie said, of payments that are made regularly. And the idea is that since your loan is taken out at a time perhaps when interest rates were much higher, you're paying much more than the market value of mortgage payments today. But you can't refinance under a regular program because you don't have any equity in the house, and usually you need to have an 80% loan-to-value ratio, which means that the house is worth 20% more than the amount you're borrowing. So if you're current on your mortgage, but your home has little or no equity, and your loan is one that's, as Jackie said, backed by Freddie Mac or Fannie Mae, then you can qualify perhaps to have a refinance to take the mortgage down to a level, the interest rate on the mortgage to a level that's more in line with what interest rates should be today.
So at least for the HARP 1, the first effort, you mentioned about how the loan-to-value, there was about an issue about 80%, but then they talked about refinance somehow being 125%. You may or may not know about those things,
Yes.
but suppose the average person is thinking about wanting to do this. They might not know necessarily what that 125 is. Do they need to go to their banker first?
The difference, actually, as I understand it, between the two is under the first HARP, you only could be negative up to 125% of the value of the house. There is no limit now. That's one of the changes.
Yeah, well, actually, one of the changes is that you can have, the loan-to-value has to be greater than 80%, okay? Under the old program, 99% of the people were upside down.
Yes.
So if you're upside down, there is a different program that you can apply for. Instead of HARP, the federal government has other programs that you can apply for. And just going on the HAMP.gov website, it gives you a list of all of the different programs. But the new programs, again, you have to be current on your mortgage for 12 months, and unfortunately it doesn't help many people because they're always delinquent on their mortgages, and sometimes it either ends up in the loss of the house or a short sale or ultimate bankruptcy.
Do you qualify, you might be in arrears in total amount, but if you're making those payments, even if you're not quite able to make the whole amount, does that count against you?
If it was under the HAMP program and they re-amortize the loan, so they wouldn't consider it delinquent, because what they'll do is they'll age it forward. As long as you're current on that, my understanding is you do qualify for the HAMP program.
So we said
The HARP program, I'm sorry, the HARP program.
We did say we were going to provide resources. You mentioned HAMP.
Yeah, homeaffordablerefinanceprogram.gov or makinghomeaffordable.gov, or just Google HAMP.gov or HAMP, and there's a wealth of information. You want to go into the government website because the first few things you'll see on Google are all advertisements. So that's what you have to do.
Good to know.
Yeah, and if you want to know if your loan qualifies as an FHA-backed loan, those websites will enable you to do that. You can just put the name of your loan in, and it'll tell you if it qualifies.
There's also a HARP, HARP.gov, too.
Yes,
So,
Right.
correct.
resources.
Right. And as you're talking about that HARP program, as Jackie was saying, it's designed for people who are current on their mortgage, but are paying more than they should be because of the loan-to-value ratios and the equity not being in the home, so they can't refinance to the better rates. So some people might ask is whether or not they're eligible to refinance if they have two loans, because a lot of times what happened was you'd have a mortgage and then you needed to do some work or something around the house or needed money for something, so you'd take out a line of credit or a home equity loan. And my understanding is when you have the two added together, if you're still negative, if you can get the person in the second position to agree to subordinate, which means to put themselves in a junior position to the new loan, then you would still qualify for the HARP program.
And the federal government does have a program for that. I think it's called a short refinance, the situation that David's describing. Also, they do have a program for those with second mortgages, and if you qualify, again, you may be able to get that second mortgage reduced significantly, or in some cases, forgiven. But again, you have to qualify, so you have to look for all of the eligibility requirements. Unfortunately, those eligibility requirements are the same thing, as you have to have 12 months of regular monthly payments.
Regular, but not necessarily the whole amount, it still counts?
Nope. If you make a half a payment, they're going to consider you delinquent.
Okay.
So it has to be the regular monthly payment, whether it be under a HAMP, under a modification. If you had gotten a refinance previously under HARP, you wouldn't qualify.
It's a nice try, Debbie, but you can't try to tell your mortgage company you're regular if you're only paying half of your mortgage each month.
Yeah.
So, good to know. So, when it came to talking about foreclosures, as we have in the past, there were a record amount of foreclosures. Some were done improperly, some were done properly. There's still quite a few in the queue. Apparently, they were up the first quarter, but now there may be fewer, at least in Rhode Island. Rhode Island apparently was number 2 in the country for some time, but now they're better. So now that means that the banks are giving money. They were wary before, maybe a little less wary now, or maybe they just ran out of money at some point.
Well, I think also what happened is those that foreclosed have foreclosed. So now what we're left at, David and I know this is municipal court judges, we're left with a lot of abandoned homes because the banks are buying the homes back instead of selling them at foreclosures, and they're not maintaining the properties, for whatever reason, they just lie fallow, and then the cities and towns get involved because they either have to condemn them, or they're not mowing the grass, or who knows, it could be squatters. So it becomes a problem where the banks are actually having to pay large fees. And eventually they'll put it back on the market. But the foreclosures, they probably just dried out because most of the homes that were in that situation either A, were foreclosed on, or maybe they complied with the HARP program and were able to refinance or modify or short sell.
I understand when they were first doing those mortgages that we read that the banks were just wary of doing it. They had lots of underwriting liabilities, and apparently that's a little bit different now with the HARP 2, which is even extended, I guess, the deadline. Maybe you can touch upon that too. But apparently now the lenders don't need to be so wary. They should be more likely to grant loans or mortgages. So apparently, from what you're saying too, the ones that have been cleared out have been cleared out, and now what we're dealing with are those who are in a better position to qualify.
Right. And as you were saying, the underwriting requirements for income eligibility and proof and verification of income are a lot more relaxed under the second program than they were under the first. It seemed like everyone I talked to who had consulted with us going through these things couldn't get through. They're eligible every which way, but they couldn't get through the underwriting to get the loan approved. So part of this program is designed to make that easier. And the second part of your question, I don't know, I thought Jackie may have touched on it already, was that they extended it to December of 2015.
Correct.
Explain a little bit, how was it, even if it was earlier on, that a consumer might come to you with the problems of the HARPs and HAMPs? Was it because they were in foreclosure or threatened foreclosure?
As you know, I do a lot of bankruptcy work, so I was seeing a lot of people coming in, and the main reason for the financial difficulties were loss of job, illness, the downturn in the market. They were in variable interest rate loans, so when the market plummeted, their interest rates went up. So by putting these people in bankruptcy, you're able to modify the loans through the bankruptcy court, which is much more efficient than doing it through the federal government program. Some people don't want to file bankruptcy, some people don't qualify. So the choice was try and modify it, help the person modify it. If it wasn't an FHA-backed loan, then getting the lender to cooperate was purely voluntary. They did not have to comply. So where we came in is we would help these people modify the loans. It's a long process, and there are horror stories out there. You'll get a package together, and you won't hear from the bank for months, and the next thing you know is you get a letter from the bank that says, we need current information. And then they take a few more months to get back to you, we need current information. So what we do is we follow up with that. And once there's a lawyer involved, it's much more efficient.
So, and once you're involved and someone has said to you, I'm in the process of trying to qualify for HARP, HAMP, or whatever, does that stopgap the foreclosure being issued, or does it delay the process? In other words, someone's in the corridor of trying to find a solution short of bailing.
Well, remember, we have the foreclosure statute now in Rhode Island, so for a lender to try and foreclose, they have to at least give the borrower ample notice to try and modify the loan. Going through the HARP program, I believe it would be one of the qualifications.
But remember, the HAMP program is to modify the loan, and when
The HARP is to refinance.
To refinance.
So we were seeing a lot of
HAMPs.
on the modifications,
Right.
yes.
Because on the HARP program,
You're current.
you're current. And so sometimes people have other questions that they'll talk to us about, such as, can I borrow money out to pay off other loans, which you can't do because you don't have enough equity in the first place to take out enough to refinance your current loan. And another question sometimes was they want me to shorten up the term of my loan. Is that a good idea? And anytime you can do that and keep the payment close to what it was before, you're building up equity that much faster. If you go from a 30-year to a 20-year loan or a 15-year loan,
You get a better interest rate.
the interest rate gets improved,
Yeah.
and you're paying off the principal that much quicker, so you eventually will get back to a positive equity position in the home. And that's the whole idea of the program.
You bring up an interesting point, David, and I think that somewhere in my readings that apart from the remortgaging and the modification, it gives access, the programs give access to the consumer to learn about how to do a better job of managing finances, and I guess at that point you'd be reading or hearing or learning something about those issues, as well as why it's good for you to make sure that you pay the loan. I mean, surely that's a good thing to do, but apparently under these programs, it certainly has greater consequences, i.e. something to do with forgiveness of it. Is that just HARP 2?
Or HAMP.
HAMP, no, HARP 2.
HARP 2 is one of the programs that they have, is you can actually forgive some of the debt, like a second mortgage, you can modify it, or you're saying it's completely forgiven?
No, but if you pay, you have up to $1,000 a year for 5 years, so potentially $5,000 of your past debt could be forgiven for having qualified for HARP 2 and have been on good behavior by making those payments as you need to. You who understand much about how the credit industry works and bankruptcy, apparently is there perhaps a big punch at the end of the line with what they call a balloon payment? Explain what those are, because apparently that may be a very big issue for someone who's unaware, and our consumers may need to know about that.
A loan that has a balloon payment means that you're going to pay, let's just say it's on a 30-year note. So you're paying the principal and interest on a 30-year note, but the balloon note is at the end of a certain term. So if it's a 5-year term or a 10-year term, you have to pay the entire principal then due at that point in time. That's not really something you're going to see in the HARP program, because that's not what it's designed to do, because they know you're not in a position to do that. Otherwise, you wouldn't be applying for something in that program anyway.
What was happening before the housing crisis is they were giving no doc verification loans to anybody. And they were selling these balloon loans with a lower interest rate. And what happened was, when it came time to make the balloon payment, then the borrowers didn't have the money to do it. So they would be told, well, don't worry about it, you have a lot of equity in your house, you can always refinance. But what they didn't plan for was the bubble bursting in the housing market. And now what happens is you've got a balloon payment that's due, your loan to value is nearly zero, and you have negative equity, and now you're faced with a situation which is, what do I do?
Right.
You can't get another loan, they're upside down in their loan. So it created a problem, and you definitely, David is right, you definitely can't get that in one of these government-sponsored programs.
So when they not refinance, when they change the mortgage rate and your payment structure, there's apparently some sort of a cap on how much it can increase, but only so much for so many years. And that would, I assume, mean that the person who's servicing or likely to grant that HAMP is likely to tell that consumer up front, good news for you, you might save $500 a month or whatever for X years, 5, 6 years or whatever, but be aware that this is going to increase X dollars for each year up to, and then it's going to have a cap on it, and then you will owe. They'll go through all of the paperwork and the numbers.
Modifications too.
That's what you're talking about there, is where some of the money that you're not paying is getting set aside in what you might call a balloon note, but I would call deferred payments, so that at some point in time that money is going to become due and owing. So, as you say, you'll save money for a period of time, and then at the end, the money you saved, you're going to have to use to pay that off later. And so a lot of people will say, well, these HARP programs really worth it for me. And so what you have to do is go and do an analysis, is how much is the loan going to cost? Because there are fees associated with taking out the loan. There's title fees and attorney closing fees and that type of thing. And then you have to balance it off with how much are you saving per month and for what period of time, and then it's really a simple math equation to determine whether it's worth doing.
Would a good responsible bank or service provider do the number crunching for and with the consumer, or do they need to go to the lawyer and say, please
Not
tell me?
necessarily, no. If you look on the website again, it gives you the eligibility requirements and what you're required to provide for information. Before, what was happening is, before we had these government programs, we had these banks that were overwhelmed with modification applications. They didn't have enough people to service those loans, which was the reason why it was taking so long to get them through. What we were finding in the bankruptcy court, Rhode Island has a loan modification program. The bankruptcy court was overseeing it, and the lender had to hire a local attorney to follow through with that, so that we were on a strict time schedule to get it done. And I've actually, some people would have had to be put in bankruptcy just for that reason. to get the loan modified and to avoid a foreclosure.
I mean, understanding that the consumer needs to provide documents that verify how much money they make, what their capability or potential ability is for paying these new terms, these new rates, and these new final amounts. Suppose the road to whatever is paid with good intentions. So I understand there's some sort of a trial period after they've done this. They get to look at it in 3 months to make sure you're doing as you said. And suppose you did think you would be able to make that payment and then something else happened. And we've been hearing, I was working, I just got sick. I mean, I might have had a full-time, then I went to part-time, then something else happened. So then what happens? If you were in default for even health reasons versus I lost a job, do you get another bite at the apple, or are you then in foreclosure and you're done?
Once you're approved through the HARP program, you can't then reapply. The government does have other programs available, but you can't get it, repetitively because of certain issues.
Can you stagger HARP and HAMP? I got the refi, and now I need the modification because something else happened. Can you piggyback those two? I mean, they're two different things.
I don't see why not. I think you can. Because again, as long as you're still current on the loan.
Yes, so before you end up in trouble, that's the time to enact or get HAMPed.
When you were talking about some of the documentation you need or don't need, one of the things the new program did do was eliminate the need for an appraisal, which can be a little bit expensive. And the reason I think that happened is because you're no longer under a microscope for how far underwater you are. You can exceed that 125% of the loan to the value of the property ratio. So the appraisal is no longer required.
Good to know. How about our military? If you're serving, how are they hopefully positively impacted by these programs?
Well, the federal government does have a program through the Veterans Administration for people that are in that situation. So they, again, go back onto the website and you can see if you qualify.
Apparently there are also a couple of credit unions and banks who make special provisions for those who are either currently serving, and then sometimes they even extend it, as I understand it, for a year or two once they return, but they do try to work with them a little bit. And I guess I would ask, when people come to see you, are you finding that they've done that mostly because they just have exhausted their opportunities and just are exasperated, so they have you intervene on their behalf? Because most people do want to start by going to these websites that we're suggesting first. That is the first thing that should happen?
Yeah, they're pretty much self-explanatory, and you can work your way through the website and figure out most of it. A lot of folks come to me and Jackie, especially Jackie, when they're a little bit beyond the HARP end of the program and are more in line with bankruptcy maybe being necessary or something like that. So then you start looking at the home situation, and does a bankruptcy wipe out enough debt so that you can now afford your home, and now that that debt's been wiped out, maybe you can pay for the 12 months if the home's under water and then apply for the HARP program. Because, correct me if I'm wrong on this, I don't think the HARP program has any rules that you couldn't have filed bankruptcy.
No, the only rule is that the loan to value has to be at least 80%, the consistent monthly payments, and then it couldn't have been refinanced under HARP previously, so you can't piggyback HARP and then another HARP. So those are the only. The other thing people should know is if they're unemployed, the federal government has a program for people that are unemployed. So you want to look into that as well, because they have an unemployment program. And again, obviously if you're unemployed, you're delinquent on the loan, so you don't have that same current payment status requirement. But you have to show that you are unemployed and that you had not received a modification under the HAMP program. And so there are some programs that are available to people for that.
If something's too good to be true, beware.
Yeah.
In some cases, it seems that right now, the HARP may be a very good thing for people, whether they needed it or not. So why would you caution someone to not do that? What's the downside of them applying for refinance, the Home Affordable Refinance Program? Is there a downside?
The only way I would caution them is if it's absolutely obvious that they can't afford the payment.
And if the expense of doing it outweighs the benefit. If the monthly payment's not going to be reduced enough to make that worthwhile because the interest rate hasn't gone down enough, or the term of the loan doesn't improve the payment so much that you don't get the benefit of what you're paying out to do the refinance.
Okay, and I think of one of the things, suppose someone is thinking about getting out of their house on good terms, perhaps in 3 to 5 years. Does that make you suggest or think twice about going through this at all? Because once you've refinanced, there must be some caveats. Do you have to stay in your house another 3 to 5 years once you've gone this route? Or maybe it just isn't financially worthwhile to do it if you're going to be out in 3 to 5 years?
I don't know that there's a caveat for that.
Okay.
Yeah,
I'm not
and
sure. I don't think there is.
even if there isn't, which I don't think there is
There
either.
would be under Rhode Island housing.
Right.
Under Rhode Island housing, there's a caveat.
But
Okay.
in this situation, you're doing this, Chris, there isn't any equity or very little equity in the house anyway. So what you're saying is if in a year, 2 or 3, the value of the house has either gone up or you've paid down so much on principal in that period of time, now there is equity, well then of course you would want to sell if that's what you want to do to get out. But if there's no equity, I don't know what the rush to get out would be because you're not getting anything out anyway unless there's enough to pay off the mortgage and get out without a short sale or some other deficiency.
Explain, now that you've mentioned it, exactly what is the short sale?
When you sell the house for less than the payoff on all of the loans, so you have negative equity, you put the house up of the market, you're asking the lenders to take less money for the sale of the house. And they had the Mortgage Relief Act President Bush put into effect, which basically said that if you qualify for a short sale, again, the lender has to agree to it, the debt would be forgiven and it would not be subject to taxation, so it wouldn't negatively affect your credit, nor would you be taxed on the canceled debt.
Okay, good to know. So not always does a lender say, I agree to this, but are they more likely to now because more people have?
Well, it's better to get money than no money at all, because if it's subject to foreclosure, the finding is that you're not getting the money that you thought you would be getting.
And if they thought through the whole process, if we can get 95% of our money out now, rather than foreclose, and as Jackie said, keep the property on the bankroll so that now they're responsible for all of the fines and other things that might come their way because they don't maintain the property, they may save money in the long run.
The other thing, too, if the borrowers don't want to go through the short sale, then again, the federal government has a foreclosure alternative program, even if it's not one of the Fannie Mae, Freddie Mac qualified loans. I will tell people, why don't we try and do a foreclosure alternative, which is a DIL, which is a deed in lieu of foreclosure. So I would negotiate a transfer of the real estate ownership from the borrowers over to the bank so that they can get out of the house without having the embarrassment of a foreclosure. And in some cases, and definitely through the federal government, you can get up to $3,000 in moving fees. So we in the business call it keys for cash. So that's available as well.
Should we make one minor point here about what happens to your credit? If you do a HARP or a HAMP, is your credit score dinged, and should you care?
Well, no, your credit score is going to be dinged. It's going to be dinged.
Should you care?
Yeah, you should care, but it's better than having a foreclosure on your file. Again, if you have regular monthly payments under the HARP, your credit score is improving on a month-to-month basis.
It's improving?
Yes.
Regardless of the fact
And
that you had
the
before.
modification.
That's good to know. Have you found that there are fewer foreclosures right now? Have you been having to deal with fewer?
I have.
Good
I
to-
have.
good.
Only in this area.
Okay.
They're rampant in Florida right now.
Do you still tell people to beware of the foreclosure scams?
Oh, yes. Yes,
And
definitely.
And there are websites that you can check into to make sure that that doesn't happen to you. We once again want to thank the Bazar Grasso Law Firm in East Providence. Stay tuned. Our discussions of legal matters will continue. We invite you to join us.